This next section I'm pretty excited about. A lot of you ask me and ask my team consistently, what's happening with these big tech exits, these IPOs, these unicorns? Is pricing getting too frothy? Are there too many IPOs? Is there enough institutional demand on the buy side? Are there enough equity analysts to cover all these new issuances? How should I be thinking about planning for IPO? Should I get in pre-IPO, and how much earlier before the IPO should I get in, or should I wait for and try to get an allocation at the IPO or post-IPO? All great questions, and we're going to try to answer all of them and give you some really good insights. I'd like to welcome a very good friend of Sway Ventures to the stage right now, David Chen. David is the global head of the software banking practice at Morgan Stanley. They are the lead underwriter or co-lead underwriter on the vast majority of the big tech IPOs. And David and his teams do a lot of this banking. He's got a team in Manhattan right now that's, I think, just finished or about to finish the book for tomorrow's listing of Uber.
About to finish, yeah.
About to finish. So he may get a text message while he's up here with the final pricing, not to be confused with media conjecture that you've all read about. So he'll pipe that into the crowd once he gets confirmation from his team. So David's going to give you a little bit of a lay of the land, kind of a foundational view of what's happening on the landscape for tech. So please give me a warm welcome for David Chen.
All right. Well, thanks very much. Thank you very much, Brian, for that. We thought we'd kind of give you kind of straight from where we're seeing it, kind of working with all of these private companies and public companies. And, suffice to say, it's been a very busy time. So why don't we jump in with the kind of the macro climate. Probably can't read all of that, but basically we had where we come and kind of where are we going here. So if everyone remembers, we had a Q4 volatility blip here, and that was kind of caused by probably two things. One, the Fed, in my perspective, kind of mismanaged the view on rates and kind of the communication to the public. And the second, of course, we had Trump kind of really starting his trade rhetoric. And then, so that kind of sent us into a downward spiral in the fall time period. There was a point where there was literally no convertible issuance. There was a point where there was literally no high yield issuance for a period of about a month and a half in the fall. So dark times, but then we had some green shoots, relative to some pretty positive news from employment, some pretty positive news in terms of consumer confidence, retail sales. And then, obviously, the biggest thing kind of toward the back half of last year, beginning of this year, was the Fed basically doing something that I consider pretty unprecedented, which is just coming out and saying, you know what, very dovish sentiment. We're basically, we're done for the rest of the year, which was pretty interesting. They've never seen them do that before. And so that obviously sent stocks up significantly. And ever since then, it's been very positive, obviously, up until the last kind of 72 hours from a trade perspective. But in general, stock market in obviously very fine shape, as all of you know. And so kind of, if you just zoom out, where does that have us from a global macro perspective? And in general, I think what we're seeing here is everyone kind of is talking the last 6 to 9 months about kind of, are we in a Goldilocks stage from a macro economic perspective, which is, in April, we saw the jobs report put out something like 230,000 in the U.S., whereas the U.S. Wall Street consensus was something like 190,000. So we just shattered consensus in April. and at the same time, unemployment here for the three major power economies in the world at 20-year lows. So at the same time, you see on the right-hand side, inflation remains kind of at a 20-year average. And so that kind of gives you a thesis that is the economy kind of in that perfect balance between good fundamentals, strong growth, but at the same time not too hot to cause the Fed to go and raise interest rates. And of course, you guys probably saw on May 1st that Chairman Powell came out and said that he's going to stay flat, given the fact that he's not seeing the inflation pressure. So we're kind of playing out a Goldilocks thesis in the macroeconomic perspective, which is not everybody's view, but it kind of seems that way today, which is obviously a very healthy backdrop for all of us. So kind of how does that dovetail into more specifically what we're seeing in the IPO market? So one of the key indicators that we all focus on is just kind of volatility levels. And for me, I've been doing tech IPOs for about 20 years. If you go all the way back to some of the best issuance climates in the last 20 years, they've been things like kind of obviously 1999 and 2000, where volatility dropped to around 13, 14. And then, I remember kind of 2004, and then 2006, 2007, early part of 2007, before the financial crisis, also kind of in the mid-teens. So some of the best risk-on equity issuance climates were there. You can see where we are now, basically around low, kind of 12.9, 13 on the volatility index, which is about as good as it gets. And that's driven a very healthy level of new issuance momentum. I'll say momentum because obviously you can see that we're off to kind of a slow start. In any given year, and this is just technology equity, any given year we tend to see, call it 30 to 40 tech IPOs. And you can see just in the 2019 period, we've done 7 so far. And it's already kind of May. So we're off to a slow start, and that's largely driven by what we saw in the first slide, which is that Q4 volatility, I think, put a bunch of issuers on pause. But trust me, given the fact that literally my last week, I think I had an average of 17 conference calls or meetings per day last week. Things are going off to a roaring start in terms of the tech IPO market. So with lots of stuff in backlog. And why is that? Well, it's a very favorable climate. And I'll take you through a few data points to suggest why it's so favorable. One question is, okay, well, do I want to invest in the IPO asset class? Has it made money so far for investors? So here, this is basically the class of 2018 and the class of 2019 tech IPOs. And you can see, call it well over 2/3 are above kind of where they priced. And, the average kind of median return is call it around 22%. So, I've seen that chart, in, call it, 2009 in the malaise of the financial crisis, or in 2002. So in 2002 or 2009, that chart would be literally all red and maybe a couple of green bars. So we're basically on the opposite side of that in terms of have investors made money in the IPO asset class. The other reason is actually that there's too much money out there. To kind of Brian's question, there's too much money out there to actually put to work, and that's largely one piece that's driven that is all of the M&A that's happened. We can see here, the blue is basically net inflows. So an IPO that happens or a company that issues primary equity into the stock market would be blue, and then the red would be driven largely by M&A. So in 2016, if you remember, in the tech market, we had 2 stocks that basically reported, down earnings, and then they both went down 50%. There was LinkedIn and Tableau, and that caused a big kind of the first SaaS crash we'd seen in a while. And that basically brought down valuation levels from a target perspective, and that drove a very, very significant level of M&A activity as the buyers kind of swooped in. Tableau, or LinkedIn, Microsoft would be one of them. And of course, recently we did things like Red Hat. And so when $30 billion of market cap gets wiped out, and all those proceeds going to go back to the fund managers, where are you going to put it? So, over, call it $400 billion has been taken out of the market in the last several years. And then on the supply side, how many companies are there for fund managers to actually invest in to drive real alpha in the portfolio? Well, if you just look at the software and internet class, which is the primary two primary segments that have most of the growth here, of the, call it 315 total software and internet companies that are publicly traded, actually only about 10% are actually growing above 30% if you actually bound it between $1 and $10 billion market cap. So kind of small. If I'm looking for small and mid cap companies to drive real growth, there's only a small number of investable assets. So we got small number of investable assets. On the previous slide, we got a lot of capital to put to work, and that's why a lot of these companies are all getting ready. So this is just a smattering of logos that I think everyone on Wall Street is focused on, and so it's a lot of new innovation in enterprise technology, a lot of new innovation, obviously, on the consumer side. So just, in 30 seconds, I'll just give you, I see a lot of stuff in terms of open source. So the revenge of open source as a generator of a, new technology, but actually a great distribution model to get your business to market. A lot of stuff in next-gen analytics, a lot of stuff in terms of infrastructure. And then also fintech is really, I think, going to be pretty interesting over the next several years. And then, of course, consumer internet, and certainly in terms of things like the gig economy, fashion, apparel, and next-gen e-commerce. So a lot of stuff to do in terms of the IPO pipeline. And then what are these companies thinking about in terms of how attractive is the IPO market? Well, all of that stuff I just showed you is now driving a high degree of scarcity and supply-demand imbalance for growth issuers. As you can see here, what we're showing here is the IPO pricing environment. And so this is not where they trade, but this is actually where we actually price these deals on a revenue multiple basis. So I'm kind of graying out kind of two areas. One would be the best climate since in the last 15 years, and that was kind of 2013 time period when we did IPOs like ServiceNow, Palo Alto, Workday. Workday we priced at 8.5 times forward revenues, which was just unprecedented at the time. And so that was a great time. And then the trough was of course kind of the financial crisis, in more recently. And then moving forward, you can see where we are today. So this gives you a pretty good look. If kind of 8.5 times Workday pricing was one of the best in the last 15 years, we just did some of these deals, a Zoom, for example, at 14.5 times very, very recently. And then PagerDuty, which was also a strong company, priced at 8.5, 9 times very recently. So very, very nice climate for an issuer perspective to generate great IPO at strong valuations. And that's obviously driven by just the prevailing climate. These are basically where the comps are trading. And this just takes one segment, which is software. And this gives you a nice historical look. So this goes all the way back to 2002, back to kind of the bubble collapse. And you can see that what I was describing in the 2013 time period, the white line is the top 5 highly most valued software companies at any given time. And then the blue line is the average. So you see the top 5 currently trading at around 20 times revenues forward, which is back to where we were in 2013. So very, very healthy climate right now. And this is kind of an eye chart. I'll just give you a takeaway. The takeaway really here is we always kind of ask ourselves, is the market rewarding or focused on growth or profitability? And, obviously that's a complicated question. It's going to differ by investor, but this is one way to kind of just cut through that. And so, for example, let me just give you the axes. So on the left-hand side, we're looking at basically revenue growth versus revenue multiple, very simple. And then on the right-hand side, we're looking at revenue multiple, the same revenue multiple, but then we're adding revenue growth to free cash flow margin. And so if the right-hand regression is more correlated, then that means obviously that investors are more focused on balanced growth and profitability. And then, vice versa for the left. I can tell you back in 2016, in March of 2016, when the market crashed, This was totally inverted. There was about 0.1 correlation on the left, and you had about 0.8 correlation. I've never seen the correlation so high, about 0.8 correlation on the right, which means investors were totally risk off. Here, effectively, the opposite has happened. You can see much better correlation on the left, so investors are clearly focused on rewarding growth, and this kind of dovetails into lots of my conversations with CEOs and CFOs on thinking about the plan and whether to invest or not, and what their financial profile should look like right before they go public. Lots of issuers right now are kind of, doing large expansion capital rounds to have the ability to kind of invest into the IPO because they're solving for the left, not the right. All right, and then a couple of case studies. A lot of times I get asked, hey, what do I need to look like to go public? Well, just look like Zoom, and then you should be good to go. So I'll give you two case studies. One would be obviously a very ideal case study from a financial perspective, and this is huge revenue scale while growing 100% with 80% gross margins and free cash flow positive at the same time. So scale, high growth, and profitable. So this would be probably an outlier in terms of what you can achieve, but this is obviously the gold standard, and we saw a higher level of oversubscription from an IPO perspective than pretty much any tech IPO we've seen in the last 25 years with Zoom. And then, also a very high quality company, but just to kind of step down in terms of the paradigm, this would be a very good company. It's a pure play SaaS company in the infrastructure space. Call it 100 million trailing revenues, growing 50% historically. The forward model is in and around kind of high 20s, and not terribly profitable, but not losing a ton of money. And so and also strong gross margins with attractive net dollar retention rates. So this would be an example of a very good outcome for a company that is absolutely a very high quality company, obviously not at the Zoom level. So this kind of is the bookends in terms of the spectrum of the financial profile that I think investors are looking for. So just kind of takeaways, would just be, I think the market is absolutely rewarding growth versus profitability. If you're not profitable, and obviously we're seeing that with IPOs that we're doing very recently, like today, I think the more you're, farther away from profitability, I think the more it's important to actually have very specific metrics to demonstrate, from a cohort perspective or from a LTV to CAC perspective that you can actually get there over time. But in general, what I tell companies is, we look for kind of 100 million trailing revenues, strong gross margins, and you don't have to be profitable as long as you're growing kind of 30%. And maybe I'll just go to this slide. This is kind of the checklist. As long as you're kind of growing 30% with that kind of revenue scale, you can probably be free cash flow negative for, call it, 4 to 8 quarters, depending on the type of business model you are, given the regression chart I showed you, which is a market rewarding growth versus profitability. And some of these other things would just be, obviously a TAM that I look for kind of 5 billion plus, but it's really less the number, but it's more the backing around the number. Investors typically look for a tops-down IDC Gartner analysis, but then also a bottoms-up analysis as well. From a unit economics perspective, I think investors are applying a lot more scrutiny to how you get to your TAM number. Covered the growth point. Scale, I think investors are looking for IPOs that kind of hit or eclipse at least about $1 billion market cap in and around the time of IPO. And then just a few of these other ones, obviously diversity across products and customers. The competitive landscape would be great if you can demonstrate a clear lead. And then, don't come, if you're going public, generally they don't want a story where you're going to come back to me because you don't actually have a fully funded plan. Just a few minutes on the M&A market. How does that lead to what's happening on the strategic side? Here you can see the dynamic I was describing in terms of the crash in 2016 and then the significant uptick in M&A activity that resulted from that. And then what we saw was kind of a doldrums as the valuation level continued to rise in terms of the prevailing kind of software multiple. And then finally we saw kind of capitulation, because basically buyers, they were on strike for a long time as they saw valuations hit newer levels, until they finally just said, look, I got to jump in the game. And so that's why you've seen this effect, which is here we're showing basically the next 12-month revenue multiple for strategic and software deals, strategic and sponsor deals, and the dark blue are the more recent cohort, and the gray are older deals. And you can see most of the dark blue bars on the left are some of the biggest multiples, anywhere from kind of 10, all the way to greater than 20 times revenue multiples for the more recent software M&A deals. This is kind of an interesting chart. This has 8 software deals in the cloud that have been the most high profile over the last, call it couple years. And what you can see here is that it's really interesting how, if you look at 6 of the 8 of these transactions were the largest in the buyer's history. You can see that 8 of 8 were the ones where they actually paid the most, and then 6 of 8 were actually preemptive transactions. So we have a kind of a new paradigm where buyers are paying higher and higher multiples, and actually stepping on the gas on companies that are truly transformative, and doing some of the biggest deals they've ever done. And we've also have the return of the stock deal. So you probably remember kind of things like what Ariba did way back in the bubble, where you have kind of rising tides lift all boats, and everyone feels good about the market. And you have 2 companies that are super highly valued. They don't really want to pay cash. There's a great synergy opportunity. You're kind of starting to see that now, and so we now have 3 of the 8 deals actually had a 100% stock component as well. So which is nice, because we didn't really see that a lot over the last 10 years. And then last slide, in terms of this is my imperfect storm slide. In M&A, we look for kind of 3 things. We look for buyer confidence with CEOs. So large companies need to feel good about the macro. Feel about their own growth forecasts and fundamental demand. I think clearly that's a check, given everything we just covered. And then obviously, do they actually have capital to put to work? I think clearly that's a check, given certainly if you just add the amount of repatriation, possible cash that these buyers have access to, plus a very healthy investment grade and high yield and convertible markets. That's not the issue currently. The issue right now is actually the lower right, which recovered, which is that we are kind of in a new paradigm. Certainly, if you're looking at publicly traded companies, and also obviously the private companies will then peg themselves to these public companies, and so it creates a little bit of heartburn if you're a buyer. So I would say the storm continues to be imperfect today. But that's not stopping a lot of buyers. We're still seeing, I think, a record amount of momentum and M&A activity, going into 2019. That would be it.